Buongiorno a tutti. I am Paolo Sironi, your host of The Banker's Bookshelf. The Banker's Bookshelf is a podcast show where I invite authors and researchers of the most interesting books and papers that define the present of banking and its fintech future. And today I'm super excited for a conversation that I'm hosting. I basically invited Patrick McConnell, the author of Digital Money, Operational Risks and the Threats of Operational Resilience, to explain the content of his brand new book that was published at the beginning of this year. And it's actually not his first book. I think it's his fifth. Patrick, welcome to the show.
Thank you. Thank you very much,
Patrick,
Paul.
I followed your work since a few years, and I know you're very well substantiated. And every time I read your pieces, I learn something new. So I'm sure that the audience will want to stay till the very end. And at the end, they will feel compelled to buy your book, which is an extremely relevant piece of work that really decodes the essence, the opportunities, but also the risk management problems of the transformation of money. So a couple of words about yourself, Pat. Can you introduce your experience?
Okay, I'm an IT geek. I have been all of my working life, which is, you can see from my gray hair, quite a long time ago. First decade was really spent in medical systems and in advanced telecommunications. So it was what was called the internet before the internet, and it stood me in good stead since. But I've been in risk and finance for over 35 years, starting really with core banking systems, lending, etc., dealing room systems, which we built some of the first digital dealing room systems in the world. And then I moved on to risk management, first with credit. And it's a good transition, first with credit, then with market. And then whenever operational risk became important, I got involved in that, as you would do if you're an IT person. As you say, I've written a few books and I've written lots of papers as well on operational risk management, especially for the Risk Journal. And this book really came out of, like I'm guessing a lot of books, came out of the COVID-19 times when we were forced to sit at home and think. Maybe thinking it a little bit too long, but I was forced to think. And I tried to put together some stuff that I'd been thinking about over a very long period of time around the issues of digital money, what it is, where are we at the moment, and what are the possible futures. Okay, so I've got nothing to sell about the possible futures. I've laid out what I think the current view is. I've laid out some ideas about where we may be going. But then I've stepped back and tried to put a bit of thought about what underlies the change as we're going forward, in particular around concepts such as cryptography.
Yes, so Pat, we have a common background. So we both worked in risk management. I was in quantitative risk management in the 1990s. I say that I work with a lot of romantic in finance that in the end generated the global financial crisis.
Yeah.
And somehow now I deal with a lot of romantic in technology. So people that just expect that just being technology is good. In reality, that has deep implications in the way system works and they are or not resilient. In the Global Outlook 2024, which is a publication, actually 2023, which is a publication that I have in every January in my role of the Global Research Leader for Banking and Financial Markets at IBM, the Institute for Business Value. I said that the next crisis, the next systemic crisis, might not be financial in nature, so coming from the structuring of payoff, but might be operational in nature. And when it's operation, it's about technology, because the way technology is used is becoming more and more pervasive. Systems are getting more open. And a lot of new technologies are, let me say, unstable in nature.
Yes.
Being more delicate, more complex, or more probabilistic in the way they are applied compared to the past. So this book comes really to help in terms of understanding why we need to care about these aspects of complexity and instability to make sure that whatever we do with technology is done with strong foundations Otherwise, the consequences will be extremely annoying and devastating. So now let's start from this operational risk. Operational risk grew in importance. However, I would say it has never been interesting. Let me tell you this. Like market risk is about dealing with money, becoming rich. So people want to know about, the dynamics of financial markets and what I did. Credit risk is always important because it has been for many years now, a bit less the backbone of a financial institution. But operational risk was kind of boring. Like looking at the past, these strange distributions that never reconcile with the mathematical model. However, in the age of digital money, in the age of artificial intelligence, operational risk becomes sexy because it's all about risk management in these technologies. So just highlight a little bit, the intersection between operational risk and digital money, and then we deep dive into the content of the book.
Okay, well, I agree 100% with you, but I would, since I've written a book about it. The book's a monster, right? It was far too big.
It's a monster.
It's a monster, right? 700 pages worth. But I feel as if, in order to get a comprehensive picture of where we are today with digital money and where we might be going with digital money, you need a lot of underpinning of what's going on today. And what's the theory behind it all? Operational risk has had a lot of theory that's gone nowhere. So, in fact, I've started again back at the beginning and asking, well, what does it all mean? Not so much somewhat for operational risk, but also for money itself. So, the book's really broken down into 4 parts. The first part is really a picture of today. Where have we come from? What are the trends that are driving the uptake of digital money? Because digital money, the uptake is quite large on various dimensions. The second is about the type of digital money. The third is what will be the impact of that digital money on operational risk functions and also firms themselves. And the last is a little bit about the theory of money. So the first chapter is really taking a look at where we are today. And what got me when I started doing the research is that basically we use digital money all the time. Everything we do is digital money. When we put our cards in a point of sale system or put our cards in an ATM machine, that's all digital. There is no physical aspect of money whatsoever. So when I did the analysis and did some of the data gathering, I worked out that most of the money that we actually use today is digital. And actually has been digital for probably the last decade. And that really is based around the instant payment systems coming to the fore. So there's really a number of things. I call the decade from 2010 to 2019 the decade of innovation in finance and technology.
So if we take a look. This
Sorry?
is very true, Pat. This is very true. So money has been already digital since a while. Yep. However, things are changing. So it's good to identify what are the real things which are changing in the way money is basically accessed and basically is ownership is orchestrated among the various counterparts.
Yeah. Okay, but I'll come to that in 1 second. Let me get the technology out of the way. From 2010, there's been an enormous change in the technology used in the financial system, really starting with the cloud. The cloud has been a major innovation, which effectively allows banks to be distributed, information to be distributed, and kept safe. Then we've had blockchain, which I can discuss or not. It's not as big as some people believe it is, but it's still quite important. Then there's smartphones. I mean, 2008 was when the Apple smartphone really started to come on board. And a lot of people went to their smartphones to do banking, right? I know people have used their PCs, but now people use their smartphones on the move, walking down the street. And last but not least, there's been an emergence of cryptography. Because once you start to move money away from bank vaults, physical money, into what is digital money and what is information, cryptography becomes of the utmost importance. It's important, but it's under the radar at the moment. When we get to real digital money, it's going to be very, very important. So if we take a look at what I'm actually talking about here, it's right across a number of different asset factors. First of all, there's what's called commercial bank money. It's what we have in our bank accounts. It's what we put on our cards. It's what we use at point of sale. It's used everywhere. And that has given rise to a belief that physical money is going to disappear. So the first real conclusion I came to was, yes, over time, probably not in my lifetime, physical money will disappear. But it's increasingly around the world being moved towards what is digital money, money which is pure information, not physical. It's about moving money.
Okay, so we already said a lot of important things. First of all, you identified key technologies. Cloud is here to stay. Blockchain is not what people expected in the past.
Yes.
Smartphones are ubiquitous. In a recent research, we saw that 86% of consumers already access the information about their bank account through mobile technology and not much on the website.
Yeah.
And then we have cryptography, which is getting extremely relevant and comes to the forefront, thinking also about quantum computing and the need of being quantum resistant. So these are like four major technological elements. And then you mentioned that money is information.
Yes.
So there is an important aspect, and I would want to conclude with this one at the very end, so we can take the audience through a journey of understanding and then lead with, if you like, the crown in terms of the representation of what money really is. So the interpretation of how technology intersects the change of its nature. So let's start from the trends. So now I appreciate when you open the book in introduction saying that you don't know the future. That's what I say as well. And many people could not forecast exactly. Maybe not only the technology, which sometimes, at least hardware, the more law, it gives you a hint, or for a long while gives a hint, but the application of that as it's more complex to understand software, how it is developed, when it is applied and how it is applied. However, there are some key trends that we can all discuss and you identify. So I noted a few. I'm not sure if they are complete in your view, like complexity, the volatility of the system, the fact that everything becomes real time, and it all more and more global, right? So we had local schemes, now they get interconnected.
Yes.
So are these the most important, or you want to highlight some?
Well, those are very important, because that's being driven by information technology. I mean, I don't have to tell you this. The fact it's global, and that I can buy something from a website in New York from I don't use mobile phones very much because I'm a bit of a skeptic as regards security, but I do a lot of all my banking online, so I can do something that's almost real time, right? So in some instances, it is real time, but we're moving towards real time, and I've noticed that. And part of that's to do with the growth of what are called instant payment systems. At the beginning of the decade, 2010, instant payment systems were new on the block. Since then, they've become basically the new technologies in a lot of areas, like Brazil, for example, its PIX system, and in Australia, the MPP system, which basically guarantees if you use the system, it guarantees a delivery with under 10 seconds immediately between banks. There's been some problems rolling that out, not with the technology, but with user acceptance. But anyway, it's all moving towards the situation, and that's led people to believe that cash is going to disappear. I don't buy that. Cash will be reduced. It's reduced everywhere when you look at the statistics all around the world, but it's not going to disappear. So what we're moving into is what I call a less cash world rather than a cashless world. And what we're going to replace a lot of the cash movements is by technology, by information technology, and then there's the move towards information. So having sort of established that the world's not going to end, that cash is not actually going to disappear, I then started to take a look at, well, what's on the horizon? And obviously what's on the horizon is things like cryptocurrencies. So I started to take a look at, well, what does this actually mean? And I came across the model that, in fact, technologically driven money will be driven by the type of money, and most specifically the type of issuer of money. So today we have money issued by public bodies, mainly central banks, and that will continue. And central banks will deliver things called central bank digital currencies. Although in my opinion, that won't happen for another quite long time. They've got a few barriers to get over. Then there's the traditional commercial banking money, which is basically transferring checks to cards to rings on your finger and all of that type of stuff. And then there's the privately issued money, and that comes in the form of cryptocurrencies, mainly Bitcoin and Ethereum. There's a lot of other beasts in that particular part of the zoo, and then there's new types of private money, such as stablecoins and tokenized deposits, which have got a fair chance of maybe moving into the real world. So there's this breakup now of the three types of money: commercial banking, public, and private.
So, but let's go step by step, because they're introducing important concepts. So first of all, I said there are some trends which are relevant and can be discussed: complexity, volatility, real-time, and global. And you said the one that you would focus the most is real-time, so instant payments. I give you a data point. I made a research on banking for small and medium enterprises, and I asked 1,200 entrepreneurs worldwide, or small and medium enterprises, what do they expect from their bank to become more efficient in doing their work. And the vast majority, everywhere in the world, even in Asia Pacific, where instant payments are more the norm, or in Brazil, they said instant payments for all operating expenses. That means not just the money that people give them when they buy the services, but also paying the salaries.
Absolutely.
And of course, that is mapping, the need of forecasting analysis, or the analysis of how money is, generated in their business. So there is a clear demand everywhere in the world to become more instant in all relationship. It's basically like the digital money becomes the same thing of your wallet, where you could get the money immediately in, right? So you know what you have and what you don't. And so that's important. However, at the same time, I would say the way this is orchestrated might bring in complexity. And when things are over-engineered, think about some blockchain examples, is never good. So the problem is how to strike that balance between the need and simplicity to achieve that need, right? So that's super important also for the control of operational risk. So that's the first message. So instant, everything becomes instant. To be instant, the way things connect changes significantly. And also the virality of a problem, when that occurs, scales up exponentially. So now, knowing that everything becomes instant, you started introducing three forms of money, or digital money. And there's an interesting diagram inside the book where you overlay these elements, finding the connecting points, though they're not the same thing, but at some point they start intersecting. So you just said that we have public digital money. I would simplify this in the shift between from cash to, let's say, CBDCs, central bank digital currencies. So then you said that we have commercial bank digital money, and it's like moving from checks. When you send something to someone, it takes time, to be recognized in your account, to instant payments. So everything is immediate in the relationship. And then we have a private digital money, which is sort of, before we had coupons or loyalty schemes, if you like, but now we have cryptos, right? So Bitcoins is the most known and interesting one. So how do these three intersect?
Well, the intersection between commercial banking money and public money has been through real-time gross settlement systems. Okay, it's a bit of magic that happens somewhere in central banks that suddenly make privately issued money in the form of commercial banking money public money, right?
And it is central bankers, magicians, or sorcerers.
I think it's the commercial bankers who are the magicians or so.
Okay,
but the key point about it is that it's not. It's net transfer of value. It's not absolute. It's not instant. It's not specific transfers of value, atomic value transfers of value. So there's a bit of magic goes on in the background that says if I make a payment to somebody, it goes through my commercial bank. The commercial bank settles it. in quotes. But in order to do final settlement and finality, it's moved up to the central bank, which then settles it. Okay, now this all happens under the covers. It all happens by some sort of magic. So, and that's been, I believe, since the 1950s, maybe slightly before that mechanism. And it is magic. It happens under the counter. Now, on the other hand, what we have is a demand. I don't know how big the demand is, but a demand, and it will grow for privately issued money. And the forefront of that is obviously cryptocurrencies, but they're a long way from being able to get into the system. But things like stablecoins and tokenized deposits, which would be issued by private companies, mainly banks, but not necessarily, the mechanism for turning those into probably settled money with the central bank are as yet unresolved. And part of the unresolved nature of them is that they're not like money. They're slightly different to money. For example, they're issued by someone who may go bankrupt. Okay, whereas we know technically the central bank can't go bankrupt. So what we have is the potential, but not yet the realization, that some of these new types of money will become part of the system, an integral part of the system. They're not there yet. They operate on the side. They operate independently on the side in the case of cryptocurrencies. But at some stage, it's possible, and I would say probably in the longer term, likely, that some of those new digital instruments which are issued privately will become part of the system.
So, Pat, what do you believe is the element that will allow them to become part of the system? What is missing today?
What's missing today is fundamentally mechanisms that allow and ensure that private money in the form of cryptocurrencies, well, let's say stable coins, can be transferred between people, you and I, without having to think about their credit nature. What's called the singleness of money. They've got to obey the rules of all other types of money. No, we're not there yet. And there's legal issues, there's technical issues, there's all sorts of risks. But I believe enough people are working on it that it might happen with a reasonably high probability, certainly over 50%, but nowhere near 80 or 90%. So we're in this. So the next generation of innovation will be how do we take those types of instruments which are different to our current money, and if we want to, and this is the point, if we want to, how would we integrate them into our existing system? And I came to the conclusion that that's going to be very difficult, not impossible, certainly not in the short term, but at some stage, there's a possibility if things are maneuvered the right way that it will happen. Whether it'll be worth doing or not, that's a completely different issue.
Understood.
Does that make sense?
Yeah, it does. And by the way, stable coins or CBDCs? Do you have a view?
Oh, I mean, they're two entirely different animals in the zoo. CBDCs, I don't like making predictions, but I predict they're going to be put on the back burner for another few years, just given the history of what's happened over the last decade. Stable coins will rise in importance, but will they become money? I don't see that happening in a few years' time. And part of it is what we're going to talk about now, which is what are the operational risks in doing this stuff, right?
Yes, absolutely. Because the point is operational risk is being transformed. Yeah. And every time there's a transformation, we have a hard time in grasping, the essence of it. So there may be some elements that we already understood, others which are not yet discussed. And I know measurement is not management, is very different, but is a good starting point. So which are these operational risks and the resilience aspects that we need to consider today, and how do we basically change our approach in order to be capable of managing them?
Oh, okay. Well, first of all, having done part one and seeing what's happening out in the real world, it came to I started to analyze it, and I looked, and I came to some common features with some of this new technology and new types of finance. And fundamentally, the common features was the expectations were completely irrational.
Irrational.
People expected that tomorrow everybody's going to be using a cryptocurrency. People expected that there'd be an instant replacement of all systems. You know, we just pull the switch, and next day there's a whole series of new systems all around the world, which are suddenly going to talk to each other. And of course, you know, I've been in the business long enough to know that that's not going to happen. There was a lack of thought around how you transition from where we are today to where we want to be in the future. Nobody had thought about that. Apparently, it was just going to happen magically. You know, Bitcoin would become the world's currency. I've seen this by 2022. That hasn't happened. And there's a lack of thought about how you go about doing the implementation, right? You know, what type of technologies do you need? What type of technology architectures do you need in order to integrate these new beasts into the zoo, right? And the last but not least, and this has turned out to be one of the real bugbears, how do you get humans involved? Because humans are the people who will use money. And humans have been using money all their lives, and they're going to be very loath to change unless there's a good reason for doing so. So a lot of the thinking about the new types of digital money just completely forgot about that. When you start to think about it, then you start to realize it's not going to be easy. And that's where your operational risks start to come in, right? So, go ahead.
You know, risk is not usually priced inside the system.
No.
Operational risk is hardly priced inside the system.
That's correct.
Resilience is never priced inside the system. Still, it materializes. Let's just consider what happened in Spain just some weeks ago. There was a huge operational and resilience risk blow, and people could not access the money, so only cash was viable at the time, right? So resilience is not like a distant future; it's a reality today already.
It's a reality today, right? And becomes more real as the use of cash decreases. Now, the use of cash will not go to zero, right? So we will have cash somewhere, whether it'll be.
By the way, I have an interesting data point for you. Last year, there was 20% more demand of cash compared to the year before. Not just cash, US dollars, cash.
Yes.
Okay. Well, and that comes from Africa and Asia Pacific. It's very interesting data point on how people and maybe businesses consider the value of the greenback inside their own ecosystem in case there would be like an emerging market crisis or something like that. If you cannot get gold, at least have dollars under the mattress.
It's what I call the cash conundrum. Okay. There are people are definitely around the world are using digital means to access their money, but it's not going away. And to be truthful, at the bottom of it, we suspect a lot of it might be illegal use of money. It might, but not a lot of it, but a significant amount. But we don't know. We don't know. People are very loath to give up money, to give up physical money. And when you think about it, you know, everybody's understood money from the age of 3 or 4, right? So they're going to be wondering about what's coming down the pike. And in fact, there's a very good statistic that even in the countries that have very low cash usage, they tend to keep something of the equivalent of $50 in their wallets. And that's one of my party pieces. Whenever I'm talking about this, I ask people to take a look at their wallets. And a lot of people have $50, $100 in their wallets, but that's all. And then when you ask why you keep $50 in your wallet, the answer is operational risk.
Yes, it's true. It's actually, sort of a good state of mind, right? So you know that in case, right? I always say that, look, in case, but that means money is emotion. That is how I defined it in my financial market transparency theory. And I remember when I presented it at the event of the Arab Summit, which is where the behavioral economists and the economic psychologists gather, they were all surprised. It's not rational in the sense that it's not a mathematical formula that describes the future of your investment and, the prices. But money is emotion because it's born in a sense to facilitate survival of the human being in very complex societies, right? And the way we share basically the value, because not everybody can work for getting the food on the table. So, the way we do that is very different.
Yeah.
And somehow we forgot about that. Maybe epigenetically remained inside our DNA. So what some of the behavioral scientists call a bias, I call it a warning. When you define it a warning, right, is the brain tells you, hey, hold on a second, maybe you better keep $50 in your pocket because you never know, right? And please do so because you never know.
Well, and part of that is that point I made about the fact that the move to the new environment, the move to the new digital world, people really did not think through what the human impact of that was. What is the impact on people who all their lives have had money in their pockets, and now they're supposed to take it away and not use it? That's not going to happen. It's for a whole series of reasons. For some people, it will happen, and some people have already done it. There are some people who don't keep any physical money. They tend to keep some at home, though. There's two places where it is. It's in your wallet for instant use, but also at home. But a lot of people feel happy, feel well keeping something. Even I do as well. But anyway, let's move on. What we're missing so far is the fact that we didn't think about how people will use digital money.
Mm-hmm.
And that's been the bugbear of a number of different initiatives. And I think it's the bugbear of CBDCs, because not even the Chinese could impose their will on people using the digital yuan, right? The digital renminbi. People pay lip service to it, but they don't want to give up their physical coins. So we people watching this as well, for the next 20, 30, 40, 50 years, will still be using cash. But as we move forward, they'll be using more and more digital money. And that brings with it all sorts of operational risks.
So I think this is very important because, for example, I've been invited to speak at the Innovation Summit of the Bank of International Settlements.
Okay.
And that was like a couple of years ago. And I enjoyed attending all those conversations. The researchers of the BAS are right, I got to tell you. However, I noticed that the majority of the conversations were about technology aspects.
Yeah.
And not much was about monetary policy, the impact on how society works, how people relate to the problem, which is in reality even more important because that has to be designed inside the system, and it's not like a buy-side product. And I also know that in your book you highlight the need of getting a different interaction between like the business side of the equation and the technology piece. And that also brings to the surface the fact that people don't just use cash, but they also need to understand how to use cash. So there's a huge skill gap that needs to be addressed.
Oh, yes.
So
yes.
What can we learn by reading the section 3 of the book?
A lot, I hope. but I haven't solved the people conundrum. Yeah, and no, I want to. I don't want to impose my vision of how I use digital money or cash on other people. That's not the right thing to do. So we know there's a generation. We know there's a cohort of people who are in their late to middle life who are unlikely to move towards a fully digital world, and that has to be accommodated. It has to be. I mean, it's part of being human. You have to accommodate that. Now, looking at population statistics around the world, that means it's going to be at least 20, 30 years before those people drop off the perch, as they say. But even then, there'll be people below that and who are currently probably in the 30, 40, 50s who are so used to using cash, they won't want to give it up either. So we have to face the reality that cash will be around for a long time. It will diminish in use and be replaced by digital means, some of which, but not all of which, will be attractive to ordinary humans. Okay? So part of it will be building the technology that's attractive to people. It's actually not that difficult to do, but from a technology perspective, from a human perspective, it's actually quite hard to do. And that's where some of the operational risks come in. And some of the technology risks come in as well, right?
Okay, so now there is an intersection between how people use money, how people understand money, and the technology that comes with. If we think about the transformation of money and the essence of digital money, we need to have good theoretical foundations.
Yes.
And throughout the book that you explain that money is information.
Yes.
So I guess understanding how information flows dictates basically the way you need to basically shape technology to make sure that that is done in a protective way. So can you highlight a little bit about this concept?
Well, if you take a look at a note, you're in Germany at the moment, and if you take a look at a Deutschmark note, I don't know whether you have any.
It doesn't exist anymore. It's a euro.
That's true, the euro. That's absolutely true.
But still, I suspect that many Germans keep the Deutschmark.
Having worked in January for a while, I'm sure you're right. The point about it is that it's, after all, it's only a bit of paper with plastic on it, right? These days, it's plastic more than paper, but it's something that's not worth a euro. It's something that represents potentially the use of a piece of paper to buy something. And what makes that piece of paper useful? It's the information on it. It's the fact that it's a certain color. It's the fact that it's got something that says issued by the European Central Bank. It's got something that says here's a number. It's got something that says here's the person who does it. So what makes that piece of money useful? And money's all about usefulness, right? There's no one definition of money. If you can give it to somebody and they accept it, that's money, right? As long as they can give it to somebody else. So even what we call cash, even what we know as cash, is nothing more than information, right? So whenever we go, for example, to pay at a point of sale service for a cup of coffee and we wave our card, there's no money moves there. The only thing that moves is information. It's information from your card to the point of sale service, to the provider of the service, to the bank, and it's immediately debited or credited. You know, the computers do magic things. Where it's debited or credited now with the cloud, we don't know. Could be anywhere, right? But we know that somewhere along the line, the process of debiting and crediting happens. That used to be physical. It's now completely, since the early 2000s, it's now completely virtual. You know, you don't know where your money is. It's in a cloud base somewhere in a bank. So then the question is, where's your money? How is it protected? Where is it? How do I get it? And those are issues of cryptography. They're issues of regulation and all of that. So it's become, so the background of money has become virtual as well. You know, the regulation becomes very important. Do we know how to do regulation of digital money? Not quite yet. We're not there yet completely. So that has to change.
It's actually, if you like, how can I call it? It's a composition of the security and the cryptography, like the demonstration that is a store of value, because you basically say that money is a store of value, is a medium of exchange, is a unit of account. It's a store of value because, and if you think about it, you have the signature of the central banker of the banknote. That is, it's signed, right? So that means it's worth, somebody is defending it, right? It's a medium of exchange because you have the face of the queen or the king and the banker. So wouldn't you accept, the face of the king or the queen, as you trust that? And it's a unit of account because you can count the money and see the same number on your bank account. But now that money becomes more and more digital, you have to protect everything, around that. So even that signature can be different by, token to token, right? So it's a huge decomposition of this aspect that has enormous implications.
It has enormous implications. It's got enormous implications both for the use of money and the people who now protect money, who we call banks, because they don't know where the money is either. They've handed it over to IBM or somebody else to go store somewhere, which nobody really knows anymore, right? We don't know where the information that makes this money is. But let's go back a little bit to the book, and one section of the book about Claude Shannon. Now, Claude Shannon is one of my personal heroes, right? He's effectively the guy who invented information theory. And one of his great insights was you make information more secure by adding information to the information, right? Okay, so let's say you're going to make a payment of $100. By adding a cryptographic key to that, you make it more secure. So the key is going forward that whenever we look at value, the value itself is really not that important. What's important is the information that's added to that value. That means it's a euro. That means it belongs to Paolo Sironi. That means that it's, it's $10, 10 euros or 100 euros. So the point about it is that now, having taken the money away from the bank vault and put it somewhere, God knows where it is, then we have to have a way of ensuring that at least we have some satisfaction, some certification that it's valid money. And the way we have to do that is by adding information to it. And that's what's called cryptography. Right?
Which is the new central bank signature.
The new central bank signature.
But not done by a central bank anymore.
It could be done by a central bank for a CBDC, but it could be done by somebody else for a tokenized deposit.
So, Patrick, to conclude, what do you believe is the biggest operational risk or resilience risk that we are facing?
Well, I'll talk about resilience because as I went through the book, this became more and more important to me. During the second decade of innovation, lots of things were put into the world, most of which just disappeared. But now we're left with a number of different types of digital money emerging. And then you've got to ask yourself the question, well, how are they going to get into the system? And the problem is, if you take a look at it, these innovations are all going to come together in the next 5 years.
Mm-hmm.
Okay, 5 to 10 years. This isn't something that's going to happen 50 years away, right? This is something that supposedly, the European Central Bank is talking about at the end of this year coming to a decision on when the digital euro will come. Let's assume it will come. That will be happening around 2030. Around the same time in 2030, most of the work around the DORA Act will be coming into play, and then there'll be cryptocurrencies coming. And they're all focused on core systems, and one core system in particular, which is the payment system. So payment systems will be being changed every week, depending on what the latest flavor of the day is. They're monster systems anyway. I mean, the Bank of England is already having a problem changing the real-time gross system it has, which is core to everything. Okay, the RTGS is the animal that everything's going to go through. They're having difficulty implementing an update to that. So if we can't even get the basics of something we know right, what are we going to be doing with things we don't know? So we're in a situation where there's the potential for a large number of things coming down the pike, which are interfering with one another. They're driven by different political drivers. They're different by political firm drivers. Some firms will want to get into cryptocurrency, some won't. And they're all getting now focused down onto the payment systems, right? So my worry is, and regulators are starting to come to realize this, that there's so much going on that it's a recipe for disaster. And the disaster will come last part of the 2020s, between 26 and 2030. And if we add post-quantum computing on top of that, governments are saying you got to get that fixed by 2021, 2031, 2032. So there's an immense amount of work that people are assuming is going to happen. They assume we're going to have a CBDC. They assume we're going to have a stablecoin. They assume all of that, but it's all happening on the same piece of code. And, having been in IT for a long time, I know that's unlikely to work.
So, Patrick, to conclude, I would say that it's effectively all happening now.
Yeah.
Okay. Yeah. And the shift is happening, changes is coming, but it's a bit over-engineered. And what's over-engineered, to me, it never works. So we need to be careful about that. So we need
very careful.
Consider all aspects. And that's why this 700 pages book is not a monster, is a good foundation. So I invite everyone to start by reading your book to understand exactly what is going on and what is at stake. We really tried to distill its content in 30, 40 minutes. I don't believe we service that well because there's so much inside. So I invite everyone to go and read it. Digital Money, Operational Risks and the Threats to Operational Resilience is a banker's bookshelf recommendation. It's my personal recommendation to all of you. So, Patrick, thank you for the time you dedicated to this conversation. Speaking to the Banker's Bookshelf audience, I invite everyone to stay tuned for more conversations with book authors and researchers that shape our understanding of the banking and financial market present and its fintech future. Now, don't forget to subscribe to the Banker's Bookshelf to receive a polite and kind notification about the new episodes on your preferred streaming platform. We stream on Spotify, Apple Podcast, Amazon, and YouTube. Thank you very much for all who attended this conversation. Thanks, Patrick, for your time and wonderful job. Arrivederci a tutti and enjoy the jingle.